If you think you're diversified because you own 5 different stocks, think again. In a storm, many boats sink together. That's correlation. And if you don't check it before you place a trade, you might be doubling your risk without knowing it. Today I'll show you how to use correlations like a pro, so your portfolio doesn't move like one trade in disguise. Correlation measures how two assets move together on a scale from -1 to +1. +1 means they move in lockstep. -1 means they move opposite. 0 means no consistent relationship. Traders must calculate correlation on returns, not prices. Daily or weekly returns over a rolling window like 30, 63 or 90 days. Rule of thumb, greater than +70, that's strong positive. +30 to +70, that's moderate. -30 to +30, that's weak or none. Less than -30, that's negative. So why it matters? Hidden concentration. Buying multiple names in the same theme can behave like one jumbo position. False diversification. 10 stocks can still be one bet if they are highly correlated to the index. Smoother equity curve. Combining low and negative correlations reduces swings and drawdowns. Options reality check. Selling strangles on correlated names isn't diversification. It's just more of the same risk. Crisis regimes. Correlations often spike towards 1 during sell-offs. Build for peace, prepare for war. How do you check for correlations fast? Use daily returns for last 63 trading days, that's about 3 months, as a baseline. Compare your new trade versus your largest existing position versus your top 2 to 3 current holdings and versus the index you benchmark against. So if correlation is greater than 0.8 with something big you already hold, consider smaller size, a different ticker, or maybe an offsetting hedge. You can grab the Google Sheets correlation tracker, link to which is in the bio, and I'll add it to the description as well. Now let's look at some trade setup examples. Stock picking. If two candidates are highly correlated, pick the stronger leader or better risk reward, but don't buy both. Hedging your long equity exposure. Consider adding something with low or negative correlation like a defensive sector, gold proxy, or maybe an FX hedge, so your portfolio doesn't all sink together. Intraday versus swing. Intraday correlations can be noisy. For multi-day swing trades, 30 to 90-day windows are much more meaningful. Sector traps. Financials with financials, IT with IT, auto with auto. Correlation tends to be very high. Cross-sector can help. Common mistakes. Use prices instead of returns. That inflates correlation. One fixed window forever. Markets change. Use rolling windows and recheck weekly. Chasing false negatives. Low correlation doesn't mean low risk. It just means different directionality. Still manage risk and stops. Overcomplicating. Start simple. Index versus positions and top positions versus each other. That's it. This is a simple pre-trade checklist. Calculate 63-day correlation of your new trade versus index and versus your top positions. If greater than 0.8 with something big you own, reduce size, switch name or hedge. Keep a cap on total exposure to a single highly correlated cluster. Recheck weekly or when volatility regime changes. Journals. Note correlation in your trade log. It'll explain a lot about future drawdowns. If this saved you from a hidden risk today, hit like and subscribe to Traders Cafe. Let's build a portfolio that actually survives weather.